Before you ever walk into a store, before you tap Buy Now, before a price tag ever reaches your eyes, the number is already decided. Not by the shop owner, not by supply and demand the way textbooks promise, and definitely not by you. There is an invisible system setting prices in the background, all day, every day, without asking anyone for permission. And once you see it, you can't unsee it. Right now, people are angry about prices. Groceries feel expensive, rent feels insulting, stocks feel disconnected from reality. Everyone is arguing about inflation, greedy companies, bad governments, broken capitalism. But those are surface arguments. The real story is quieter, more mechanical, and a little uncomfortable. Because prices don't start in stores. They start in places most people never look. Let me show you how. Imagine tomorrow morning nothing dramatic happens. No war, no pandemic, no natural disaster, yet prices still move. Why? Because the system that sets prices isn't reactive, it's anticipatory. Prices move on expectations first. Reality comes later. At the center of this system is something deceptively boring: interest rates. Not the rate on your loan, not your credit card bill, the base price of money itself. This single number quietly leaks into everything: rent, food, stocks, jobs, even the risk companies are willing to take. But here's the part most people miss. Interest rates don't just affect prices, they are prices. They are the price of time, the price of waiting, the price of risk. And whoever controls that controls the starting point of every other price. Now, you might think this power sits neatly with central banks, people in suits, committees, press conferences. That's the story we're told. But central banks don't set prices directly, they set signals. And the real pricing happens elsewhere, in bond markets. Quiet rooms, huge screens, trillions moving with a click. Bond markets decide how expensive money should feel in the future, not based on today, but on what they expect tomorrow to look like. Inflation expectations, growth expectations, fear expectations. This is where prices are born. Before you feel inflation, bond markets already priced it in. Before layoffs happen, bond markets already sensed weakness. Before central banks speak, bond markets already voted. And they vote with money. Here's the uncomfortable math. If investors believe prices will rise 5% next year, they demand returns above that. That demand raises borrowing costs. Higher borrowing costs push businesses to raise prices today. So prices rise because people expect prices to rise. That's the loop. No conspiracy, no villain speech, just incentives stacking on top of incentives. Now let's zoom in. A company doesn't ask what's fair. It asks, what can we charge and still survive our financing costs? If loans get more expensive, prices go up. If investors demand higher returns, prices go up. If risk feels higher, prices go up. Even if demand doesn't change, even if supply is fine. That's why prices feel disconnected from your reality, because they're not reacting to you, they're reacting to capital. And capital doesn't care about feelings, it cares about preservation. Here's the irony. We're told prices come from competition, from free markets, from choices, but the starting line is already tilted. Two businesses selling the same product can have completely different prices, not because of quality, but because one borrowed money cheaper 5 years ago. That old loan decides today's price. Past money decisions haunt present shelves. Now let's talk about hype versus reality. The hype says inflation is temporary, or controllable,
or fixable with the right speech. The reality is messier. Once expectations shift, prices follow slowly and resist coming down fast. That's why prices go up like rockets and fall like feathers. The system isn't designed for fairness, it's designed for stability of capital. That's the uncomfortable truth. Your cost of living is downstream from global money flows, from pension funds, from insurance pools, from sovereign debt markets, places you never visit, decisions you never vote on. And this system doesn't ask if you agree, it just updates the price. Zoom out further. This is why housing rarely gets cheaper, why asset prices recover faster than wages, why inequality widens quietly, not dramatically. Because assets are priced by expectations of capital, while wages are priced by negotiation and delay. One moves instantly, the other crawls, and the gap grows. So when people say the market decided, what they really mean is capital adjusted its fear, and you got the receipt. The uncomfortable part isn't that the system exists, it's that it works exactly as designed. Not to serve people, but to coordinate money at scale. Efficient, cold, indifferent. So the next time you see a price and feel confused or angry or betrayed, ask yourself one question. Was this price reacting to reality or to a future someone else is afraid of? Because if prices are being set by expectations you don't control, then who is the economy really for?